Okay.
You know, we didn't want you to know over there at Adams.
You know what? That's okay. I have one at Jefferson and one at Gateway.
Okay.
Okay. We are live.
All right, I think we have enough people to get started. We're going to call our investment committee meeting to order. Can we get a roll call vote, please?
Dr. Candace Carter Oliver, Christina Bennett, Lewis Cross,
Present.
Emily Hubbard,
Here.
Hello, Emily.
Kimberly
Hi.
Jones. Here. Shanice Johnson, Yvette Levy, Jennifer Orr,
Here.
Hello, Miss Orr.
Hi, Dr.
Bobby
Gross.
Who was that?
You're right.
Who was that?
Bobby.
Bobby.
Yeah,
Oh, okay.
Sorry.
She has to leave 5.
Okay. Albert Sanders,
Present.
Doris Walker.
Here.
So we do have 7. We do have a quorum. I guess Jeff, we'll turn it over to you.
Okay, fantastic. Good afternoon, everyone, and hopefully everyone's getting ready for a good weekend and happy Easter for those that celebrate. And we have Fidelity with Matthew Torrey and Sarah Weddleton, and they manage an international growth equity product for the system. And so they're going to give us an update on what's going on at Fidelity and what's going on with this portfolio, and hopefully give us a positive outlook. And I'll talk a little bit more about outlooks after their presentation as well from the Mariner standpoint. So with that, Sue, I'll turn it over if you want to bring them in.
Hello.
Hello. How are you,
Afternoon.
Matthew?
Hi, I'm well, thank you.
Good.
Can you can hear me okay?
Yes.
Yes,
Excellent.
Are you ready for us?
we are. So I gave the committee here a brief background on who you all are, but certainly we'll turn it right over to you, and the floor is yours. And I gave you a little bit of a bullet point agenda, so if you want to jump right in, that'd be great.
Okay, great. I'm Sarah Weddleton. I'm your relationship manager. I'm joined by lead portfolio manager Matthew Torrey. Thank you so much for having us and inviting us for this time. And you've been a client of ours for 20 years, so I want to thank you for the continued partnership. And I'm going to share my screen, and Matt's going to kick off kind of with an overview. We'll go get into team, philosophy, process, performance, and outlook. I think, Jeff, that's what we discussed before, so that's on line with what you shared.
Correct. Now, Sue, I don't know, is she able to share the screen, or are you going to share the presentation? How do you want to set that up?
It's fine if she wants to.
Okay, great.
Yeah, I'm certainly happy to do that as well.
Okay. Can everyone see my screen?
Yes.
Yes.
Awesome.
Yes.
And I'll have Matt will just kind of point me to the page numbers
All right.
as we move along.
That sounds great. Well, thank you, everybody. Thanks for the opportunity to provide an introduction to and an update on Fidelity Institutional Asset Management International Growth Strategy. It's sort of a mouthful, our full name. Again, as was indicated, my name is Matt Torrey. I've been with Fidelity in Boston for just over 34 years in various investment research and portfolio management roles. I spent 14 years as a member of our Director of Research team focused on various international equity markets. I've focused on the international growth strategy since March 2018, so just over 7 years. Sarah, if you wouldn't mind going to slide 4, this just gives you a brief overview of Fidelity. We've been around for a few years. Fidelity was founded in 1946. You can see in the middle panel of this slide, we have almost 1,000 investment professionals. So that's folks in investment research, portfolio management, and trading. And you can see on the right, we manage about $6 trillion in assets in bonds and money markets and stocks. So we manage a lot of money for folks, and we take it very seriously. You can see that we provide a breakdown there in terms of the equity assets, the stock assets, and you can see that's just over 1.2 trillion. And you can see the breakdown in U.S., domestic U.S. and international and sector-focused money. Slide 6 provides an overview of our approach. So we like to think we have a flexible, growth-oriented investment philosophy. And when we think about growth, down at the bottom of the page, we usually try to think of 3 different buckets for growth. Number 1 is secular growth, and that's where we think a company has a runway of multiple years where they're going to grow revenues or introduce a new product. And so in some way, their revenue growth and their earnings growth is going to accelerate due to something they're doing right or something that's happening positively in their market. So we have a lot of stocks in the portfolio that we would consider secular growth stocks. One example would be Fast Retailing. It's a Japanese retailer. We also invest in what we think of as cyclical growth stocks. So these are companies where, maybe they don't have a 10-year runway where they're going to have a lot of growth, but in the next 2 or 3 years, we think they're going to grow faster than they have or faster than the market expects. And in some cases, banks recently have been a good example of stocks where the earnings have improved recently and the stock performance has improved as well. So we have many examples of banks in the portfolio I can talk to you about later. And then opportunistic growth. These are companies where the management teams are just doing something right. Either they've made a good acquisition or they've sold a business that was best for them to get out of, or they're having some sort of a turnaround strategy, some sort of a change in management or strategy that's going in the right direction. So we call that opportunistic growth. If you'd go to slide 7, Sarah, this shows our portfolio management team. And I will make a couple points on this slide. Number 1, it's a multi-manager strategy. So we have a lead portfolio manager, that's me. And then we have regional co-portfolio managers for the European portfolio and the Asian portfolio. It's an experienced portfolio management team. I'll show you the years of experience on one of the next slides. Stock selection is meant to be with stock selection within regions is meant to be the primary driver of outperformance here, as you can see in the top middle box there. And we have embedded asset allocation and risk management that contributes to performance. Let's go to slide 8, if you don't mind, Sarah. This is our investment philosophy. And so we're looking for companies that we think are going to have superior earnings growth and hopefully positive earnings estimate revisions over time. We think that those 2 ingredients are very, very important. Down at the bottom left point that we make there is we are long-term investors. We try to invest for multiple years. We try to be patient investors. We think that the market often focuses too much on the short term and underestimates the long-term magnitude and duration of earnings growth that some of these companies can generate. So we like to think we think longer term than the market, and so therefore can sort of take advantage of the short termism that we see out there in the market. Slide 9, Sarah, would be great. This shows you that we have, on the first slide I shared, we showed you we have hundreds of research analysts covering bonds and stocks all over the place. On this slide 9, we highlight the research teams that actually work closely with our regional portfolio managers on international growth. Our regional PMs work with 33 analysts in Europe, all based in London. There you can see in the middle of the page. And then over in Asia, we have 2 offices, one in Hong Kong and one in Tokyo. So 22 in Hong Kong, 7 in Tokyo, so 29 in total. So the regional portfolio managers leverage the fundamental research engine of Fidelity. Our research team is one of the biggest, and we think one of the best in the investment management business. We like to think of the research as our secret sauce that goes into the portfolios, if we were building a sandwich, as it were. On the right, you can see a chart with the years of experience for the portfolio management team. The point is we have a very experienced team. Most of us have been, with Fidelity for 15 or so years. And you can see on the European portfolio, we have co-managers Sam Morse and Aruna Karunatha Lake. They are our team for European portfolio. They took over at the beginning of last year, the beginning of 2024, when the previous manager, Cedric de la Chaise, retired. And Eileen Dibb, who's the second to last on this list, has managed the Asian portfolios for many years. She sits in Boston, right next to me here in Boston. And we added a co-manager on the Asian portfolio, Stephen Liu. He's the youngest and least experienced member of the team, but still quite experienced, as you can see in terms of the number of years. Stephen sits in Hong Kong. So one of the things we like about having co-managers, it allows our portfolio management team to be in 2 places at once, going to see 2 different companies on the same day, going to 2 different meetings if need be to meet with our clients, etc. So we do believe that having more resources is better, is a better outcome here for our shareholders, for our investors. If we could go to slide 10, this is our investment process slide. So for those of you who have seen a few of these today, maybe in your committee meetings, it's sort of the classic funnel slide. You start with a lot of opportunities in the market, and then somehow you narrow it down to a portfolio. In this case, basically what we do is our research team covers Europe and Asia very, very thoroughly. They come up with buy ideas and sell ideas. Of those buy ideas, our regional portfolio managers kind of look through that opportunity set, and they put together portfolios of a best idea portfolio for Europe and for Asia. And then we sit down together and we try to make sure that this portfolio of about 100 stocks, makes sense at the top level. So we want to make sure it's not all in technology or all in financials. We want to make sure that we have some balance, not only in terms of the regions, but in terms of the sectors and the types of companies that we're buying. So it's typically a portfolio of about 125 stocks. It's currently 97 stocks, as we've had a few recent stocks come out of the portfolio. If we could go to slide 12, Sarah, and thank you so much for doing the slides. This shows you the absolute performance. Top left is regions. Middle top is sectors. The top right is commodities and oil, and the bottom is countries. So what I would say is absolute. This is all through this is the year through. Sorry. This is for the year through March 31st. And so I would say, to that point, you did see positive absolute returns for most regions of the world, most of the key indices in the world, top left. You can see there's good mix. Some of the sectors were positive, some negative in the top middle. Copper had a good year. Oil had a not so good year. Currencies didn't move all that much through March 31st. And then you can see there was good dispersion between the winning countries and the losing countries last year. So this is all absolute returns. Let's go to slide 14. This is, our absolute return and relative. This is absolute performance and relative performance for our FIAM International Growth Strategy versus our benchmark, which is the MSCI EFA index. So if you look at the first column of numbers from the left, that's performance for the first quarter. So for the 3 months ended March 31st, we had positive absolute performance, up 5.8% before fees, up 5.65% after fees. Unfortunately, our relative performance was negative for the period, as the benchmark was up even more than that. And so we had negative performance versus the benchmark for the 3-month period. If you let your eyes move down the slide a little bit further down, you can see that both the European portfolio and the Asian portfolio underperformed their benchmark during the period. If you go over one set of numbers to the right, to the 1-year number, it's a similar story. So our strategy increased in absolute terms, but increased less than the benchmark. So we trailed the benchmark by 1.42% after fees, as the European portfolio underperformed. On the other hand, the Asian portfolio outperformed its benchmark. To the right, you can see performance for longer periods, negative also for the 3-year. And you can see our strategy has performed better in the 5-10-year periods and since the inception of the strategy, which goes all the way back on the right. You can see there to April 7th, 2005. Why don't we move to slide 15? 15 provides performance attribution for the year to March 31st, 2025 by sector. As I mentioned earlier, we try to focus most of our value add via stock selection rather than sector selection or country selection. So if you focus on the third column of numbers from the right, you'll see the attribution of sector by sector in terms of stock selection. So over the past year, you can see that our stock, the positive numbers is what we want to have there rather than negative. You can see our stock selection was positive in real estate, financials, energy, information technology, and comm services. However, our stock selection was not always positive. It was negative in consumer, discretionary, staples, materials, industrials, and healthcare. Slide 16 shows basically the same setup. So stock selection is the third column from the right. And this is categorized instead of by sector, by country. And so you can see over the past year, our stock selection was positive in a number of countries: Finland, Taiwan, Belgium, Italy, Norway, China, Japan, France, and Germany. However, it was negative in many of the countries on the bottom of this slide: Ireland, Hong Kong, Denmark, Switzerland, Spain, Netherlands, Australia, and the UK. Let's go to slide 17. These are the top contributors, the top 10 and the bottom 10, the top 10 contributors, top 10 detractors for the year to March 31st by stock. I'll just walk you through 3 on each side to give you a flavor here. The top contributor was an overweight in Mitsubishi Heavy Industries in Japan. This is a conglomerate that is one of the 3 global producers of gas turbines. It also has a really attractive defense business, and a bunch of other businesses we think are quite attractive. So we were overweight in the stock. The stock was up almost 90%, and so that was a nice contributor to performance. The second contributor, I mentioned banks before. NatWest is one of the large banks in the UK, and so you can see we were overweight that stock. The stock was up 80 some odd percent, and that was the second largest contributor. Our third largest contributor was something we didn't own. So we didn't own Toyota, and Toyota didn't have a particularly good year. It was down almost 30% in the year to March 31st. So not owning it was a winner. And you can see on the bottom, I'll go through the top 3 really quickly. One of the stocks that we owned, Denso, an auto parts company. We sort of owned Denso because we didn't love Toyota. We thought we should own something closer to auto parts, so we owned some Denso. It turns out we should have owned neither Toyota nor nor Denso. So owning some Denso was and being overweight was a loser. And our second largest detractor was an overweight in Novo Nordisk, a Danish pharma company. And our third detractor was an underweight in HSBC, one of the global banks that's domiciled in the UK. So we owned a lot of banks. We didn't own this one, and this one did well. In a year like last year, owning all the banks would have been the right call. If we could go to slide 19, this provides our outlook going forward. So yes, there he is, slide 19.
I do. Does anyone have any questions on anything so far? I just want to take a quick pause.
Thanks, Sarah.
Okay. Sorry, Matt, go on.
No worries. Always feel free to jump in with questions. Slide 19 just provides our outlook. So I would say trade conflict has really created a lot of uncertainty around the world in recent months, for central banks, for other governments, and for companies. So some areas of the world are going to see some faster growth in 2025, but some are going to see slower growth. And I think all this uncertainty on tariffs could generally reduce growth as policymakers and companies need to sort of figure out how things are going to settle in terms of tariff rates. Central banks in many countries are already cutting interest rates, and the exceptions to that rule at the moment are Japan is in a process of raising interest rates, and the U.S. for now doesn't seem to want to cut interest rates as you may have seen in the news recently. There's been lots of political change around the world. So most of the major Western countries anyway have seen recent changes in government. So the UK, France, Germany, Japan, Canada, the United States. That has provided for a more volatile environment as well. One place that we continue to like is Japan. So its growth outlook continues to improve. The Bank of Japan, we think will continue to hike rates this year. And more than anything, corporate governance continues to get better in Japan. So companies in Japan used to sort of hoard cash and have all sorts of kind of funny policies, and they wouldn't return cash to shareholders very much in terms of dividends and share buybacks. We think that's changing in a material way. The government has been incenting Japanese companies to do the right thing and to pay more dividends and to buy back shares when they have extra free cash flow. And so we like that. And so we've been following a lot of improving stories in Japan. In China's critical to what happens in Asia and the rest of the world. We're seeing a slow stabilization in the property market, and improvement in Chinese policies, so becoming a little bit more aggressive in terms of trying to invest in the economy. And the crackdown that we saw in China in the property sector and the tech sector several years ago seems to be moving in the right direction now, finally. Excuse me. Most countries now are racing to engage in negotiations with the U.S. to reduce the proposed tariffs. We'll see where that ends up. Hopefully it ends up in a good place for everyone involved, and our company management teams can get back to the business of growing their businesses. As investors, we are generally accustomed to a world of uncertainty. Last few months have taken the level of uncertainty to pretty high levels, I would say. Not as uncertain as the global financial crisis back in 2008, 2009, but pretty uncertain and pretty volatile from a policy standpoint. A couple more slides for me. Slide 20 shows our regional weights. So we can have bets in regional weight, bets of up to 5% overweight or underweight the regions. Right now, you can see we have very, very modest sized bets in the regions. We are slightly underweight Europe. We're slightly overweight Asia. We think what's happening on the tariff side is materially negative for both places, both Europe and Asia. So we'll have to see how that shakes out in terms of who gets a better deal, who gets a worse deal. But for now, we're pretty close to the benchmark in terms of regional weights. You can see on the right where we are in terms of sector weights. We're overweight technology, industrials, consumer discretionary, and consumer staples. We're underweight comm services, utilities, materials, real estate, and financials. The chart on the bottom highlights country weights. You can see we have overweights in the UK, France, and Japan, and underweights in Germany, Australia, Sweden, and Italy. I would emphasize that for our strategy, our country weights are really a function of where the regional PMs are finding attractive stocks, not a function of a macro view. So we do think about the macro for the countries, but we're very, very focused on finding the best stocks out there. And if we find a lot of great looking stocks in the UK, we'll own them within reason. And let's see, slide 21 shows you the largest overweights and underweights, what we call here active weights. So these are the largest overweights and underweights by stock. I'm happy to go through any and all of these. I know the ones we own a lot better than the ones we don't in some cases. And then my final slide, I think, is slide 22. This is characteristics, portfolio characteristics, we call this. And just briefly, I'll highlight a few of these. You can see that in the second row, we have our portfolio has a larger average market cap than the benchmark. So this is not a small cap fund. It's not even really a mid cap fund. It's for the most part a large cap fund, slightly larger than the benchmark on average. You can see also that our portfolio has a slightly higher price earnings ratio and higher price to book ratio, sort of in the middle of this screen. And we think that's okay because we're trying to find companies that we think are going to have higher returns and hopefully higher earnings growth as well. So you can see that our portfolio has a higher return on equity than the benchmark. You can see on the next row there, the long-term EPS growth based on consensus numbers is lower than the benchmark. But I would add that, for us to put a stock in the portfolio, it means that our internal FMR, Fidelity earnings estimate, is almost always going to be higher than the consensus estimate. So while the consensus thinks that our stocks are going to grow at 10.3% for earnings growth over the next year, in our opinion, that's probably going to be 12%, 13%, something like that. As I mentioned before, we typically have about 100 stocks in the portfolio. We've got 97 at the moment. We've had 3-year tracking error of 3%, so we're taking bets, but it's not a hugely volatile strategy. And our turnover last year was about 53%. That's pretty much right in the middle of our 40 to 60% range for annual turnover. When our new portfolio managers for Europe came in last year, they changed about 40% of the European portfolio from where it was before. So that contributed to turnover, so making it a little slightly on the higher side, but still within our normal range of 40 to 60%. So why don't I pause there? Those are the slides that we wanted to go through. And I would, first of all, thank you very much for the opportunity to make this presentation and provide an introduction to some and an overview and an update to others. The team is very, very motivated and working hard to generate improved performance going forward. So thank you for the opportunity. I'll pause for questions.
Hi, Matthew. So first off, fantastic job of getting everything we sort of asked for in 30 minutes. So you did a great job of that. So very informative. So I kind of going back to your turnover numbers, do you expect that maybe to be a little bit higher for the rest of the year here? And that kind of goes to the rest of my question, which is, with everything that's going on with tariffs and trade wars, are there any significant or material changes you're thinking about making to the portfolio to be a little bit more, I guess, defensive to that?
Absolutely. So great questions. Thank you for that, Jeff. I do think that that turnover will probably remain in this same range, maybe a little bit higher this year, just due to the high level of volatility that you mentioned. I was talking to our Asian portfolio manager yesterday, and she's already started to make some pretty significant changes to the portfolio. So one of the things is she's had a longstanding underweight to the Australian region, to Australia, and she's been finding some good new ideas there. Part part of the benefit of adding a new co-manager in Asia to Eileen's process has been that, Stephen's been down to Australia a couple times in the past year, and we're now finding some new buy ideas that we just didn't see before. So she's been adding to Australia, closing that underweight. Some of these stocks are also, the collateral benefit is they're in different businesses. There's, we bought a retailer, we bought a mining company. So some of these are more defensive companies than we sometimes will buy. Eileen within Japan has become a little bit more defensive. So she's been buying a few more retailers. She's been selling a little bit of tech. She's financials. If you look at our performance last year, 2024, I think something like 11 of the top 20 contributors were banks, overweights in banks. And so Eileen did a really good job of owning three bank stocks in Japan. She's started to aggressively trim one of those already. And so, I think as she sells those banks, bring her portfolio a little bit more defensive as well. So yeah, if you look at our portfolio in June, you'll already see some changes driven, by the changes the PMs have made over the past couple months.
Okay. Good. Does anybody else have questions?
Yes, hi. This is Kimberly Johnson. I'm the new CFO here for SLPS. I have two questions. Matthew, you stated the first question probably relates to the second question. You stated that we went down from 100 number of holdings down to 97, so we dropped 3. What was the reason behind that? And then when I'm looking at the benchmark versus what we are holding, 684 down to 97. I know that's the benchmark. Tell me why it's such a great difference and how does it benefit us versus not having so much?
Yeah, no, it's a great question, Kimberly. I mean, if this were an index fund, obviously we would try to own as many of those stocks as possible. Now, in reality, I think a lot of times index fund managers will own fewer than every stock. They'll own the ones that matter the most. From our perspective, we're just trying to give you the best stocks that are in that benchmark in order to over time beat the benchmark. And so, for us, I think we've done a good job in recent years of really trying to focus on owning the best stocks and trimming some of the stocks that maybe they're still pretty good, but we just don't like them quite as well. And so I think, Jeff mentioned, were we getting a little bit more defensive, and that's part of the answer. So as we've become a little more concerned about the international environment and what the tariffs might mean for these different regions, I think the portfolio managers have come across a few stocks where they say, you know what, it's just hard to figure that one out right now. I'm going to sell it. And I think that's probably what took us down from maybe a little over 100 to 97. So but your question's a really interesting one and a really good one. We don't want to have a portfolio that's massively volatile, versus the benchmark, because ultimately that's what you're most focused on. But we are trying to, have like the greatest hits of the stocks that are in that benchmark for you. So, but anyway, I could talk all day long. I don't think you guys have that much time.
Thank you very much for that.
You're welcome. Great question, and thank you.
Great. Anybody else? Questions? Okay. Well, if not, we appreciate your time, and it was very insightful. And I guess the one comment I will make, and I'll walk the committee through this as well. So we have a lot of our strategies within this system compartmentalized between value and growth, and have a lot of different factors offsetting each other. And so we do have you categorized in the growth category for international, and as such, that's how we have you benchmarked. So walking through your presentation, you're sort of showing numbers for the last year that you're slightly underperforming, and I'm going to be showing everybody kind of a different story, because relative to the growth segment of the IFA, you all have done quite a bit better. So.
Correct. Yeah, no, and it's a really good point that you make there, Jeff. When you look at the IFA growth benchmark versus the IFA value benchmark, there's a big difference.
Huge.
Something like 8 or 10%. So the value benchmark has done much better than the growth benchmark. So we've slightly underperformed our core IFA benchmark, but we've outperformed the growth benchmark. And so, that's why we often talk about being a core strategy that leans to the growthy side, as opposed to a growth strategy that leans to the core side.
Sure.
Yeah.
Okay. Well, good. Well, again, appreciate it, and it's been very insightful, and keep up, keep up the good work.
We will do, and we look forward to doing this again with you all whenever you want.
Fantastic.
Thank you so much.
Good night, all.
Bye.
All right. Thank you.
Bye-bye.
Good. So any thoughts, comments? Would tell you from our point of view, and again, we'll get into it when we take a look at performance. So relative to that universe and for what they're actually doing in growth, they've done a really good job. And I guess I would talk about the other rarity being that this team that managed this has been in place for I think this is the same team that's been managing it ever since you all first made the investment. So again, we see a lot of teams that either retire folks or people leave, go somewhere else, and you have a lot of team turnover. And this has probably been one of the more stable teams that we've seen out there. And so that always that always encourages us, and a lot of that lends to why the strategy has been fairly consistent. Because again, when you see a lot of the people turnover, it tends to change the strategy somewhat, and say what you heard one year as far as here's what we're focusing on might be something different in a different year, but their core focus has always remained the same. And so again, from the standpoint of something that's very diversified, and we like this concept of all of these regional analysts and specialists and kind of giving their best ideas, it's just something that lends to a really good, not only a research process, but gives a nice diversification scheme within the portfolio. So, and again, all of that has worked out very well within this growth universe. Kimberly, I think you have a question, but you might be on mute.
You on mute? Okay.
Yes, I'm busy talking. I said I had one question that I didn't want to take up time asking Matthew, but when he talked about the 1-year turnover at 53%, I wrote a note that he says that's due to change in managers of those portfolios over in the different countries. Did I get that correct?
That was a portion of it. So yes, and again, that's where I think for Matthew and a couple of those other folks that have been around for quite a while, they're probably not turning over as much, but they did talk about this gentleman Lou, who came in, who's the newer portfolio manager. And I think within his region, he came in, looked at a lot of positions, and said, "I think we're going to make some changes here." So. And again, that kind of goes, and that's a great question, because that's sort of what I was getting to, that when you do see, so let's just say Matthew, and there's another gentleman on this that have been there like 30 plus years, that when those, we'll make a hard assessment if they retire, because someone else is going to now come in and take their portions of the portfolio over. And that's just something we keep an eye on. Are they going to make a wholesale change to the portfolio? And then do we have all sorts of turnover? And again, I know we throw around terms quite a bit. So for everybody's knowledge on this. When we talk about turnover, that just means how much of the portfolio are they buying and selling as a percentage of the total assets throughout a year. So the lower that number just means they're not making a lot of portfolio changes. And again, there's no right or wrong on that. It just comes down to strategy. So there's other managers out there that might have much higher turnover numbers. They might turn over 100% of the portfolio throughout a year. And again, it might just be part of their strategy. But for this group, their historical numbers have been in that 40 to 60% range, which again is about average relative to the universe out there. So again, for this is kind of getting off the beaten path, but for a taxable portfolio, we pay more attention to turnover because there's tax ramifications and other things there. But you all are a tax exempt entity, so we don't pay as much attention to that factor of it. But where we do look at turnover, again, is just relative to historical norms. So again, if they're telling us we trade 40 to 60% of the portfolio in a given year, and then they give us a report next year that says we turned over 80% of the portfolio, then that causes us to start to ask some questions. Why was the turnover higher? And again, that's why I wanted to have him speak about what's going on right now with tariffs, and does that really change anything with how they manage the portfolio, and do we think they're gonna have some higher turnover numbers? So we'll stay tuned on that and see how that plays out.
How are we notified when they do the turnover? Is your group notified that, hey, we're changing our portfolio strategies, and then we give approval, or is it just we're giving them that authority to make those changes and then tell us afterwards?
Right. So that's a great question, because I think it's sort of a give and take on that. I think the first part of that is we do give these managers discretion within a certain set of guidelines. So again, any separately managed account portfolio that the system has, they have specific written guidelines in the operating guidelines and investment policy statement that dictates how they operate. Now, this is a commingled fund, so a commingled fund and any mutual funds that the system has investments with, we can't really dictate those. So that's sort of going to be outlined in their collective trust operating agreements, or for a mutual fund, their prospectus. So we have to be comfortable with that on, Mariner and our group and our research has to take a look at that and be comfortable before we recommend it to you all. But there is a process that we have in place that monitors all of that. So again, there is discretion within their guidelines, but the other part of the operating guidelines that we deal with is it says if you are going to make any major changes in your portfolio, whether it's a strategy change or people change, team change, that our policy tells them they have to inform us of that. So that is something that we do track, and they have to tell us. So, and again, we monitor that. So we're getting all that report that he just went through with all of us. We get some form or format of that type of report every quarter that we go through and that our research team goes through. And again, if we see something that looks odd or they didn't tell us about it, then we will red flag that. And that's certainly from an investment policy standpoint, something that gives us a lever to put a manager on the watch list. So,
okay, thank you. That answers my question.
Great question, because there are a lot of moving pieces, but I think at the end of the day, there is a policy that they have to go by, and they do have some discretion within that policy. But if they start to go too far afield or they want to make a major change, they do need to tell us about that. And frankly, we will. We as the advisor to the system will red flag that as well, because again, we've given each individual manager within the system a mandate for a reason, so we can build a diversified portfolio that has a certain overall risk and return profile. So if any single manager comes in and says, well, we're doing something completely different today, that changes a lot of things. And so we want to know that, and we want to evaluate that and say, hey, does this worth looking at, and do we need to replace the manager? And so we have historically had a few of those and have dealt with that, and hopefully we don't see them all that much. But good. Any other questions or comments regarding Fidelity? Okay. Sue, do you want to jump over to the performance report? Great, and I'll give my famous last words. This should be brief, but we can spend as much time as possible, and I'll also throw in there that it's been interesting. So, and again, I think it's no secret or surprise, Sue, if you want to flip over to the first page, that there's been a lot of volatility that's revolved around the tariffs and trade talk. And when I talk about volatility, I really am referring to a lot of these daily moves that we're seeing in both the equity and bond markets of up 3% or down 3%, up 5% down. And last week we actually had a really nice up 10% day. So we'd certainly like to see a lot of those. But again, that's just those are the things that sort of that tend to happen around these type of events. Again, if you go back to the prior Trump administration, there was also a whole lot of tariff activity, and there was some volatility. Certainly not to this level, because this just seems to be much more elevated. But again, we did see that kind of volatility the first time around, and again, a lot of that hard lining with China, and so that's certainly something they've picked up again in this administration. So. And I think it's a stay tuned in that I don't think we've seen, I'm hoping we've seen the worst of it, but I don't think we've seen the last of it because it's not resolved. So they are slowly working through country by country negotiations and trying to get where they want to be. And those that have, countries that have been a little bit more cooperative on their program, they've been given leeway, and China was the one that didn't get the leeway. So they sort of dug their heels in, and administration came back and said, well, we're going to go to 125% tariffs there. So it's day-to-day information that the world is really paying attention to and trading on. And every time we see a bit of good news on the tariffs, we see these big rallies. And again, when bad news comes in, and today is a good example, and that's just with what happened with the Fed. So the administration right now is really pressuring the Fed, the Federal Reserve, to lower interest rates, and really the administration's doing that from the standpoint of if we lower interest rates, that's going to help the stock market and in the bond markets, and it's going to make things rally. But that's really not the Fed's mandate. So the Fed does not manage their interest rate policy to help out the stock and bond markets. It's just not their mandate. Their mandate is to control inflation and to keep the economy growing. So that's really that's their mandate. And right now they are, I'd say they're confused, because and that's what the Fed Chair Jerome Powell has been trying to convey, in that there's just not a whole lot of clarity. As long as these tariffs are out there and not resolved, there's just not a whole lot of clarity on what's going to happen with inflation. Because again, think about, there's a lot of different types of inflation, but I'm going to boil it down to there's two types of inflation, and I'll call one healthy and one not so healthy. And healthy inflation is when consumers are spending and the economy is really good, and so because everybody has extra money in their pockets and they're working and they're able to buy stuff, that creates demand for product, and that pushes prices up. So we saw that over the past several years, until we started raising interest rates to bring that inflation down. So the other inflation is the not so healthy, and that's just due to the fact that we have now all of these tariffs. And so any company that now has to import and has to deal with tariffs, well, there's only so much that they're going to absorb that in their own profitability. And they're going to say, we might be able to take a little less profit, but we're not going to take a huge cut on our profits. So what are we going to do? Well, we're going to pass that on to consumers. And so that gets passed along in higher prices to consumers. So again, that's inflationary, but it's not as healthy. And what that ultimately does is that puts a hurt on demand. So everyone says, well, if I have to pay $10,000 more for a car now than I had to last year, I'm probably not going to buy that car. Or the same thing with if my McDonald's is costing me $2, $3, $4, $5 extra dollars now because of the price of grains and everything else that goes in, and cattle and all the stuff that goes into a McDonald's hamburger. I mean, if that makes everything a lot more expensive, well, guess what? I'm not eating as much McDonald's, so I'm gonna eat cheap ramen noodles. So that's the
Joke.
that's that unhealthy inflation that's going on. And so, and again, let's kind of bring that back to how the Fed operates. So, if the Fed saw, that inflation was coming down quite a bit, the consumers were still spending at a healthy rate, but we didn't have inflation. Well, then the Fed could say, yeah, we can keep lowering rates because we don't. We're not seeing inflation and the economy's on the right track. But if you were to just not pay attention to what kind of inflation that we were having right now and just said, look at the inflation that we're going to get, the Fed would really be more poised to raise interest rates. But they can't, because raising interest rates is not going to help inflation that happens from tariffs. Raising interest rates only helps inflation that happens when consumers are spending and there's a lot of demand out there. So that's where the Fed doesn't have a whole lot of clarity. They need to see what all of this eventually means. And I think we're going to see it over the next couple of quarters, because it's going to start hitting corporations and their bottom line. And I think any company out there that sells anything, whether it's cars or Coca-Cola or burgers or anything like that, I think they're all going to start to see that demand is coming down, and as part of that, other bad things happen. And we've already started to see some of the bad things that are happening. So with the Department of Government Efficiency, so there's been a lot of layoffs in that segment. So unemployment is already going up from that. Unemployment will continue to go up as well if companies are again having to absorb a lot of the impact from tariffs. And they want to try to keep their margins or their profitability around where it's been. Well, how do they do that? Well, they have to start cutting their expenses. So and one of the primary ways to lower expenses is laying off employees. So again, these are the things that the Fed is paying attention to and saying, until we have that kind of clarity, we just don't know what we can do right now with interest rates. So, and again, I think they're pretty steadfast in saying we're not going to do anything with interest rates that's designed just to help the stock markets or to help the bond markets. So we'll see how that plays out. Again, this is a president that's been pretty vocal about the fact that if you don't do what I'm asking you to do, then even if you have another year left in your term, I will figure out how to get you fired. So, and he certainly has the authority to do that if it gets there. And then again, you have all sorts of uncertainty now, because you don't know who the next appointed Fed governor or Fed president is going to be, and what policy he's going to adopt. I mean, most certainly it would be someone who's adopting exactly what the president's telling them to do. So. And again, we just don't know what that impact is. The only thing that we do know is that we're going to see, continue to see that uncertainty and volatility in the markets. So that's long-winded about what's going on. And on this page, you can really see what that's meant for the market, at least over the past month and 3 months, and for the calendar year to date. So it's been tough for most segments of the equity market. So if you look over the past 3 months, We are negative in most segments. So S&P 500, those are the large cap stocks. Right below that, the mid cap stocks, and then the Russell 2000, those are smaller cap stocks. And again, when you think in terms of how the market reacts to things like this, it's usually a movement to what they see as safer stocks. So in this particular instance, you see that Russell 1000 value. So that's the value segment. And those are the markets that have really been out of favor over the past several years because they don't have a lot of technology exposure. So technology has been really hot, and that's pushed the growth indices. And if you look at those two colorful boxes to the right, so that sort of tells that picture. The one on the right that says 2024. So that's how all of the different styles did last year. And that's also kind of indicative of what we saw in the prior year as well. So on the right, that's the growth segment, and that's the more technology driven areas of the market. And you see those large cap growth, that's the top right corner in 2024 at 30%. To the left of that is where it says V, and then the L, that's large cap value. And again, the 2024 was a really good year for that segment, but was not as great of a year relative to growth. And so again, that's sort of been the story for the up until this year, the past several years, that the value has been out of favor. Well, because of that, things are really, really cheap there, and the market perceives them as safer right now. And so that's where the rotation has been. And so if you look now to the box to the left of that where it says YTD or year to date, that's where we've been through March so far. And you see a pretty sizable reversal there. So value stocks on the large cap side positive, and those growth stocks on the large cap side negative to the tune of about 10%. So again, the perceived safety, so everyone's sort of leaving those, and then also just the recognition of a lot of these technology companies, in particular, who are doing business overseas and with China, where a lot of technology revolves around. A lot of these companies are going to feel the brunt of what's going on with tariffs if they remain as they are today. And number two, just the fact that if you go back last year, a 33% run, and before the couple of years before that, a very strong run as well with technology stocks, they have been overvalued. And so you have everybody taking their profits, number one, and then number two, just getting much more defensive on the fact that a lot of these growthy technology companies could get a pretty sizable impact from these tariffs. So that's where a lot of that rotation is coming from. But again, if you look at this chart and then you go down in a couple lines, now I'm back to the left, the table on the left, the MSCI EFA, the last two lines, and then the MSCI EM, that's the emerging markets. So again, think about the past couple of years when we've been going through these charts, and all of those U.S. equity segments were really strong, and the international was not doing as well, and emerging markets were not doing as well. So again, those have been out of favor. So we're seeing the market rotate back to those because they're cheap. Now, again, maybe doesn't make as much sense, and always trying to figure out the mind of the market is interesting, just because, again, a lot of the countries that constitute that EFA or the emerging market international indices, they're all still going to be impacted by this tariff activity as well. So, but again, that's just been the tone of the market has said, let's move into things that have been cheaper. So again, from that diversification standpoint and things to think about, go down to the next grouping below that, the fixed income indices. And again, you see that for the past 3 months, those have all been positive. So that's changed a bit in April so far. The fixed income markets have begun to get some pressure, but at least you see through March, it has been positive. So, and again, we'll kind of talk about this when we get back into the portfolio and things that we are thinking about and what we recommend and how we talk about the structure here. But the tagline on that is just, this is why we diversify. So it's these types of markets, and sometimes we see markets like last year where just everything is going up, and we say, well, why do we even bother with all of these different segments of the market, because everything is doing great, so let's just put money in the thing that's been doing the best, the large cap growth index or the S&P. But it's this type of market where we see this volatility that really proves out why we want to have stocks of all different flavors, whether it's large, mid, or small cap, and value and growth, international, emerging markets, and fixed income. And again, fixed income of all sorts of other segments, government bonds, corporate bonds, high yield, non-US bonds. So again, just having a lot of that diversification is what helps us ride through these very volatile periods. So I'll pause there on the markets and see if anybody has any questions. Okay, if not, Sue, you want to flip forward one page? So this is our asset allocation chart, and for those that are seeing this for the first time, this is the bottom chart has all of the major, well, the bottom and top charts show the major asset classes. You can actually see what the allocations are in number terms in the table below, and then we have targets for each of these specific asset classes. And again, Kimberly, this goes back to the discussion on the investment policy. So, not only do each of the individual managers within the system have a policy, but from an asset allocation standpoint, the system also has a policy that says this is how much money we will have allocated as a target to each of these individual asset classes to provide the diversification that we want, but also give us a good probability that we meet the system's return objective over a lot of market cycles. So you can see in the table below, we have a current, well, we have the dollar asset allocation is the second column, and then the current allocation, that's where we are as of the end of March, and then the target, those are what you'll actually find in your investment policy statement. And then we see the differences and then mins and maxes. And so the mins and maxes will be captured nice graphically right above that. And again, why do we have these ranges? Well, we had those ranges I think this market environment we've been in recently is a good proof of why we want these ranges, because that equity exposure, fixed income exposure can bounce around that target quite a bit. And again, graphically up top, how do you read that? So the upside down triangles, those are the actual allocations for where the system's dollars are at the end of March. The vertical line within each of those gray shaded areas, that's the target, again, as represented in the table below. And then the gray shaded area, that is the range. So what we want to do is we always want to stay within that range. If we start to go outside of those ranges, then we kind of fall into a category of what we would say is market timing, being extra weighted or extra underweight to an asset class that could impact us in a material way if the market turns. So again, a good example would be, let's take a look at large cap equity, and we're almost spot on there. And for most of the asset classes, we're pretty close, because we just did a fairly sizable rebalancing of the portfolio. So a lot of things are going to be pretty close to their targets right now. But let's just say that large cap equity upside down triangle was all the way to the left and was outside of that gray shaded range. And then we had a 10% up day like we did last week. We wouldn't capture all of that because we were underweight relative to our target. So again, that's why we want to have these ranges. We want to not get too far outside of those. And again, that works on the other side of the equation as well. So let's just say we've had really good equity markets, which we have the past couple of years, and that triangle for the large cap equity was all the way to the right now, and we didn't rebalance. Well, we would probably lose more than we have estimated, because again, of these very large volatile days that we've had over the past several weeks. If we were overweight, we'd be losing more than we wanted to. So again, that's why we have these targets, these ranges, and this is why we do this systematic rebalancing. And so, again, this is important to talk about because when the big question that we always get, and I'm sure is on everybody's mind, is with what's going on with tariffs and all of this volatility, should we be doing something different? Because if we're going to continue to see this volatility and we have this uncertainty, should we just take everything out of the equity markets and put it into fixed income or put it in cash and try and ride it out? And our answer to that is no. We really shouldn't be doing anything different. We might be looking at things on the margins of saying, okay, do we have any specific manager in this portfolio that we think is more susceptible to any issues, and if so, should we think about resizing that? And so that's something Gwelda and I are constantly looking at. But yeah, as of today, we really don't see any major issues there, other than managers that we've sort of currently had on watch and have thought about in the most recent rebalancing. But again, our biggest recommendation in this type of market is just to continue to rebalance. Now, I know, sort of as a matter of course, we will do a major one once a year as Sue takes a look at cash flows and money that's going to be needed for the coming year for benefit payments and expenses, and that's a mechanism that we can use to rebalance. And we try not to do it a lot because there are transaction costs and other things involved. But if the markets do get really volatile, so if we have some really big continued down days, I'm going to knock on wood and hope we don't. And we start to see those equity triangles go much further to the left, we would certainly want to come back before our standard rebalancing and make a recommendation for actually moving some of those parts around. Again, we're not there yet, and hopefully we won't be if things start to settle out and we have started to see some of that volatility in the markets come down to earth a little bit. So. But that's our biggest tool right now, is just to make sure that we're not significantly underweight in equities right now, and we miss big up days, because as you saw from that big 10% move that we had in one day last year, even that didn't happen in a day. That happened in a matter of minutes, that 10%. And if you were underweight, or you took all your money, a lot of individual investors do this based on the advice of their broker. They pull their money out and they go into cash and kind of try to time the market and get in and out. If you missed a couple of minutes of that day, you missed a very large portion of the recovery. So that's why we rebalance. And again, it goes both ways. When we had very strong equity markets like we did over the past couple of years, and we did our rebalancing, we were taking our gains. We were taking the money from equity and moving it over to fixed income and keeping all of these things in check. But again, all of this is designed to keep our risk profile manageable, not have excess volatility that's going to cause us to lose out on return in any specific market, but also weighing that with, we do have a return objective in this portfolio. We want to make sure we have a good probability of hitting that over time. So again, there's going to be years where we don't hit that target. There's going to be years that we do really well relative to that target, but over market cycles and a long period of time, and for a pension fund like this, we always look at that time period as being sort of infinite. We expect this pension fund is going to be around forever, and it's just going to always be there to pay benefits and expenses. And when you have such a long time period like that, that's what we tend to think of. We have a return target of 7.25 right now. Is that right? 7%. It's 7 now. So again, a very, very reasonable return target for what we would think of a 30, 40, or almost infinite time period. That's a very reasonable target for this type of investment portfolio structure. So. Again, from the standpoint today, there's nothing that we would recommend as far as any major asset allocation shifts. We're keeping an eye on this. This is, we get these numbers every month, and we can certainly run them even more often than that if we see some big market moves out there. But this is kind of our tool that just says, if we start to see anything get majorly out of whack here, we're going to want to address that in rebalancing and try to keep all of those triangles as close to their little vertical lines as possible in the overall structure. Any questions on asset allocation or how we're taking a look at rebalancing? Okay, Sue, if you want to move forward one page. Okay, so this is the performance of the system at the top line for the month and for the fiscal year to date period, and we can see some longer time periods as well. So, certainly that 1 year period, or the latest 12 months, has now been a bit impacted by these more recent numbers. So fiscal year to date, it's about flat, and you can see what the last month is. Again, I don't want to get too far into April right now because it has been down, but we're only halfway through the month. So again, when you see 10% up days, it only takes a couple of those to kind of get us back to even. But again, we're not predicting that, but certainly I think we want to step away from thinking about or making any changes on a day-to-day or even month-to-month or quarter-to-quarter basis. We continue to look at things longer term. So even accounting for what has recently happened, the 3-year number is starting to move up in the right direction, and relative to its policy. And that 3-year number is a pretty good encapsulation of some of the changes that we've made, or we've recommended to the system and that have gone on over the past couple of years. So a lot of that encapsulated, and we have made some moves to, number one, decrease excess risk that we may have seen in the portfolio, again, to try and right size things and to move us into a position that gives us that higher probability of getting that long-term return objective. And so we're starting to see that bear some fruit on a relative basis to the policy for the past 3 years. And the 5-year number, again, big proof statement. And so again, even taking into account a lot of the more recent volatility, we still see for the past 5 years. And as you scroll down that column and look at the equity figures, so we've had some big losses recently in the equity markets, but you still have large cap equities at a 16 to 18% return. And so again, I think that just kind of points to the fact that we've had a really good run in the equity markets. Valuations have been probably at the higher end and certainly above average, and start to see a little bit of that come back to earth. But again, for a 10% return for a 5-year period, that's been very stellar. So the 10 years still encapsulating some of the bigger down years we've had over the past few. So again, that shows us that we've been a little over 6%, and we have a target that's at 7. Again, are we concerned on that? No, we're not. Again, we sort of look at it and say we start to figure in if we go forward another year and then drop a bad year, add a good year, we start to move more towards that overall target. And then I think you can see that a little bit more in the inception number. So you go back to that inception date of the end of 1997, and that number is almost at 7%. So again, that gets us pretty close to saying, yes, we're comfortable with the current asset allocation. We think if you drop the outliers for years, whether it's a real bad one or a real good one, and average things and look over longer market cycles, that we believe this is a structure that does a good job or should be getting us that 7% returns assumption over time. So from the standpoint of individual asset classes, and again, I'll focus more on the past 12 months. So just to understand where we've been, but again, you can see domestic equities in total, those have been below the overall benchmark, and a good portion of that is certainly going to be from a structural standpoint. Things that haven't done as well have been the value stocks relative to the growth. Growth versus value over the past period. Small cap versus large cap, and some of the weightings there. So those are some of the things that have created a bit of that deviation relative to the overall benchmark. Again, we think those are cyclical. Again, as we focus on some of the pieces, the large cap we have a pretty good portion that's indexed. So that's the Mellon stock index fund that's indexed to the S&P 500. So that's very low cost, and that gives us the full core of the market that really gets us a large percentage of how we want to be allocated from a risk standpoint in U.S. equities. Below that is Edgar Lomax. Recall that we did have them on watch, and they just came in and sort of gave us a discussion of their overall portfolio. And again, you can see what a difference a short period makes of just value stocks and how they outperform and what that does for a single manager's performance. And again, you can see that the past 12 months now, or the 1 year period for Edgar Lomax, has been really good relative to their benchmark. So they're at almost 10%, and they're going to be several percentage points ahead of their benchmark. So that's great. We love to see that. And again, we did reposition them a little bit. So we did take some money away from them to put it into that index. So that's the line right below that, the Mellon Equity DBSL LC value. So that's large cap value that's indexed there as well. So that's kind of an offset to what we did on the growth side of the equation. So again, right below that, you have TCW, large cap growth, and then the Mellon above that. So one active manager that we have out there picking stocks, and they're attempting to outperform an index, and then we have that complemented with an index. And the index, you're going to get what the index performance is, and you're going to get that at a low cost. So just two styles, but things that are designed to improve probabilities, lower overall interim risk of the portfolio. So again, it's good to see. Now if you go to the latest 5 year period for Lomax, they're right around where they're starting to get pretty close to their benchmark, and then the 10-year period they're still outperforming. So again, that's why we keep an eye on these things. We keep an eye on the overall risk, but we don't want to make major changes in the middle of a market cycle, because again, these are the types of things that happen in the reversals that we see. And so and again, I think the growth segment again continues to tell that story. So if you just see for the overall fiscal year where the growth stocks are, so down between 8 and 10%, whether it's your active manager or the index. So that's been prior to this year, that was our real strong performer. And again, we rebalanced. They were doing really well and kept getting larger in size. And so as part of the rebalancing, we scaled out of the growth and moved more back into value to keep us equally weighted. And again, this is, I think, just a great environment. Well, it's not a great environment, but I think a good example environment of why we like to keep all of these pieces diversified, and why we want to rebalance and not take a bet one way or the other in capitalizations or value versus growth or other areas. Sue, you want to flip forward one more page? Okay. So here are the small cap stock, mid and small cap stocks within the portfolio, right up at the top, and you can see as a group for the latest 1 year period, that's been negative as well. So again, we've started to see a little bit more rotation back to that area of the market, just because not that everybody wants to take on that small cap risk, but just the fact that a lot of these areas of the market have been very much out of favor over the past few years relative to large cap stocks. So we've seen some of that rotation and repositioning. So Westfield's going to be below their benchmark for the past year. Again, their portfolio will do that, and I think we could probably say that for any manager within the small cap category. They could be a little bit more lumpy in returns, and sometimes they will have that outperformance. But we look for them to offset that with periods where they recapture it quite a bit. So going out longer term, 5 and 10 year periods, we still continue to see those managers outperforming benchmarks. And again, as an overall portion of the portfolio, small caps, we only have weighted at 8% of the total portfolio. And again, that's just by design, because we know that there's a lot more volatility in those stocks. So having the smaller weight still gives us the benefit of getting some upside in return when the small caps are doing really well and running, but when they're not and there's volatility, it's not hurting us too much on the downside. So that's why we size that way. And international is going to be the same. So we're again, we've seen a nice rotation back. So if you look for the at the past 1 year period now, where it's been a little bit more challenging for U.S. equities, the international has done better. So you can see Fidelity, and again, I did want to bring this to everyone's attention because when they were walking through their report, they were showing their performance relative to the full developed international markets. So that's the value plus the growth segment, and growth hasn't done as well. So they didn't look as good relative to that benchmark. Here, we actually have them against a growth-oriented benchmark that's probably a little bit more indicative of what they do. And you can see they've done extremely well. So that the growth segment of the market over the past 1 year has been negative at almost 3%, and they have a positive 4% return. So that's a really good job of picking growth stocks within what's been a fairly challenging universe. And then Causeway, they're on the other side of the equation. They are value. Value has done a lot better. So you see on an absolute basis why they've done better than Fidelity. But again, on a relative basis, both managers have done well relative to their benchmarks. And again, by design, we're looking to keep those fairly equally weighted, not take a style bias one way or another within the portfolio. Emerging markets, again, we're encouraged because we are seeing better numbers in general than we have seen over the past couple of years. We are continuing to take a look at Invesco. They have been on watch, and relative to other alternatives. One thing, and I think Gwilda and I will show this to the committee over the coming meetings, are potential solutions of what we can do if we were going to replace Invesco. One of which would be just to find another growth oriented emerging market manager, and then another potential concept would be just to have one or two core managers that operate in both sides of the market. So DFA happens to have a product that has done pretty well that does that. So they're in both ends of the market. But I think ultimately we would still like to keep some manager diversification within that overall segment. So whether it's continuing to have a value and a growth manager, or if it's having two core managers within that segment, are a couple of possible paths that we can have in the portfolio. So again, we're keeping an eye on that. Certainly if you go out to a longer 10-year period for something like Invesco, relative to their benchmark, they're not too far off the mark. So it's not like over that longer time period they've been significantly underperforming. But we are starting to pay a little bit more attention to where they are in the cycle. And when we talk about cycles, 3 and 5 year would be something for us to say, why have they been challenged in 3 and 5 year period, and do we expect that to change? And are there other managers or other structures out there for emerging markets that might make more sense for us? So stay tuned on that one. No recommendation today, but that is probably the next area of this overall portfolio that we'll be looking to address. So next page. Okay, this is the Exponential, which is a global equity manager. So again, their strategy is they can sort of go anywhere and do anything in the global equity markets. So whether it's U.S. stocks, developed outside of the U.S., emerging markets, and again, they have a focus in that portfolio for newer and emerging managers within the space as well. So that is a sort of a multi-manager, what we would call hyper-diversified portfolio. They have been in the process of making some sub-advisor changes there. And again, just to address, if we take a look at the performance for the past year, they have been under, and even on the past 3 and 5 years as well, not by a huge magnitude, but again, when there is underperformance relative to a benchmark, certainly we are going to scrutinize that. We know the manager is scrutinizing that, and they are looking to address that through not only how they're weighted to their current sub-advisors, but also changing out those that might not be doing as well within the total construct. So again, that's sort of a stay tuned. We know they've been making some positive changes within that portfolio and with some of their sub-advisor tweaks, and so we certainly want to see how those pan out, and we want to get them back in line with if not better than their current benchmark. Next page, Sue. Okay, these are our fixed income managers, and again, you can see for the past year, the fixed income numbers have been a lot better than what we've seen over the past couple of years. And first comment on that is just where the floor is. So think about interest rates and the amount that the Fed has raised interest rates over the past couple of years now, and that's given us that higher floor for fixed income. So a good example would just be take a look at your average money market fund. So that's sort of the safest area of fixed income, and it's almost cash plus, but those are still at 5% type yields. That's the floor. Anything else that's getting issued out there in fixed income, whether it's from the government or from corporate, they're starting at that floor level, and then everything else is getting issued with a higher coupon than that. So that's been positive for fixed income. What is more positive is if when the Fed started lowering rates, that was good for fixed income. And again, how that mechanism works is that company XYZ goes out and issues a bond at 6%, and you buy that bond at a 6% coupon, and then the Fed lowers rates, let's just say to 5.5%, and now every whether it's the government or a corporation now comes out and issues a bond at a 5.5% coupon. Well, you have one that has a higher coupon than the ones that are now being issued. Well, that's a positive for what you hold, and so the market recognizes that, and that will be positive for your overall fixed income exposure. So it's an inverse relationship. Interest rates are going down, value of fixed income securities will go up. So we have seen that over the past year. It did taper off a bit when the Fed stopped lowering rates, but again, that's a stay tuned, because let's see what happens with the Fed over the next couple of meetings. Do they get pressured to lower rates, or do they see enough information in the data that would cause them to lower rates, and that would be good for fixed income? And again, I think what they're looking for in the data ultimately is, is employment getting softer? Is the economy slowing down? And if that is the case, that would be more evidence for them to actually lower interest rates to try to stimulate the economy. So we will see what happens there. But again, we have a very good diversified structure. We have the core piece, which is really primarily investment grade securities. It's treasuries, it's corporate, and it's very well diversified. It's really the meat of the fixed income exposure out there. And then the opportunistic, those are all the other pieces, the global bonds, non-US, treasury inflation protected securities with the Mellon product. Again, Neuberger, it's more of a global, go anywhere, do sort of anything within the fixed income. And then Lazard, which is an emerging market structure. And again, that has been through that is now fully reallocated, correct?
Lazard is not. No, we're still working on the documents for the two new investments.
Okay, and just for a refresher to the trustees, that we did have a few structural changes. So we did add an additional in that opportunistic segment, another manager that can do anything within the global fixed income markets. That's Wellington, and so they essentially will get that Lazard capital, and so we have terminated Lazard, so that moves there. And then we've also reallocated some capital from Manulife in that core segment to an additional core manager that's Loop Capital, and they're actually a core plus. So they do what Manulife and Earnest does to an extent, but they also have some other things they can do out there with high yield securities, non-US bonds that are additive to that portfolio, but they're in that core segment. So that's in the process. That's previously approved, and those changes are in process right now. So again, just things that we have designed to continue to help with the diversification and the risk mitigation in the overall system. Next page, Sue. Okay, these are the global allocation and hedge fund segments. Again, these are our real diversifiers. Again, these are sort of termed as go anywhere, do anything type managers. They can be in equities on a global basis. They can be in bonds on a global basis. They can use derivatives and other type strategies. Again, we don't weight them very high because there's a little bit of a liquidity issue in them, and again, they just because of how they operate, sometimes we just don't want to have major amounts allocated to them, but they're great diversifiers in the portfolio at this level. And again, you think about PIMCO and where they've been in some of the struggles. Now we're starting to see over the past 12 months now how that structure and what they do and on this total diversification basis has been pretty favorable. Entrust number, that's kind of off the chart, very, very small position, but we know that one bounces around just based on one position, which is a Peruvian bond, and you see where that's been for the past 12 months, kind of off the charts, but just at a $215,000 level doesn't really move the needle. That's in, we're still trying to get a full liquidation and get that money back, and that's also to be determined as to when we see that. But white box for the past 12 months, again, a nice, great nominal return at 11%, well ahead of their benchmark, and Grosvenor as well, a very good nominal return of almost 9%. So again, what is this total segment here? We're not looking for them to be as high flying as the overall equity markets, but these are really designed to minimize risk. For the most part, we want to see them give us a nice, good, absolute return over time. So something that really contributes to that 7% return assumption. So that's kind of our base level that we would expect for any of those managers to do on a consistent basis over time, but also help us minimize risk on the downside. Sue, if you want to flip forward one more page. Again, not much to report here, but this is the alternatives portfolio. Again, we're pretty preliminary in the quarter to have any solid numbers here, but one positive that I can talk about is that real estate has firmed up in a lot of the managers that we've looked at, and so where that's been over the past 3 years a negative return, we are starting to see positives. We're starting to see managers in a position to pay out redemptions. Recall that we were ultimately looking for a full redemption from this UBS Trumbull, but they don't have the money to give us. So once they come back and say we are now more liquid and we can pay out redemptions, we'll go back and look to reinstating that redemption. But in the meantime, they have given us a fee break on the capital that we do have there, and we are going to start to see better returns from that because the overall environment has been positive for these more core diversified real estate structures. And then again, nothing to report right now on any of the private debt. We continue to build that out. We'll keep an eye out for more capital calls from the private debt managers as we look to build that up. And within the overall private equity structure, we're sort of right on. But again, all of those numbers that we see tend to be on a lag, and we will pay more attention to those on a long-term basis as we look at our full quarterly reports. So I've gone over a little bit, but I'll entertain any questions that anyone might have. Again, flying in the face of my famous last words of I will be brief.
And Jeff, we may be seeing some action on the interest, those bonds. We got an email. I'm trying to clarify it, but it seems like there was some sort of settlement. And so we may be seeing that we may be getting out of that position.
Yeah, and that's right again where you see that large 100%. That's just they will mark that up if they have positive news that says we think we can get this sold. Then they're going to impact that, or they're going to reflect that in their portfolio marks. So, yeah, that'd be good to have that. Yeah, not that it's a big position that moves the needle one way or the other, but it's kind of from an administrative overhang standpoint. Would be nice to have that wrapped up finally.
Yeah, it would be nice to get that resolved because it's been, it's been for a while, but it's been
A long time.
hanging there. So.
Well, good. Any other questions? Yeah, again, as a summary today, as we stand, no recommendations for any movements. We just went through rebalancing. We're still sort of in the process of that rebalancing with some of the new managers and pieces that we've moved around in fixed income. But again, once those are done, I think we continue to be in very good position with respect to our overall structure. And again, we'll kind of keep an eye on what we're looking to do there on the emerging market equity side of the equation.
And Jeff, one other thing we wanted to touch on, it was about the June meeting.
Okay.
So the June meeting, which is typically it's the third Thursday, would fall on Juneteenth, which is
Yes.
a holiday. So I guess it's something we need to consider whether we want to move that meeting. I think Jeff and Gwelda, you both were available on the 26th. I think
Yes. Go ahead. Sir.
Items that we might be looking at doing is having PNC come in just to do a report, having them a year as the
They ain't doing nothing.
So they would be available on that June 26th date as well.
Who was that little boy? I don't know.
And I think they were, PNC would come in person, so that's why we were kind of maybe trying to see if we can figure out what we want to do a little bit ahead before the May meeting, just to give them some time to get their travel plans together.
Okay, yeah. So if that date is set, let us know. We'll put it on the calendar, and then if PNC's coming in, and I'll take a look at my travel schedule. I may come down for that as well. So.
Okay. Does anybody know offhand if they have any conflicts with that date? I mean, I'll reach out afterwards, but any other conflicts?
Is that May the 20th?
No, June the 26th.
Okay, I have no conflicts.
No, I don't either. I'm good.
I don't think I have any either.
Okay. Yeah, and typically July is the month meeting.
Right.
Month we don't have a meeting. So, okay, I'll reach out to everybody just to, just make sure. I know there's a few people not here tonight, but that may be our tentative plan then for June.
Sounds good.
Good, we're ready for the roll call.
Is that it?
That's all I have. Thank you.
All right. Thank you, Jeff. Informative meeting. I think that's it for our meeting today. And unless there's anything else, Sue.
Nothing else on the agenda.
All right. So I make a motion to end our investment committee meeting on today, April the 17th.
Second.
So there'll be no delays. Get this thing off my streets ASAP. Yes, sir.
Who is that? Okay, all in favor?
Aye.
Hi.
Okay, good night, everybody.
All right.
Good night.
Happy
Thank
holidays.
you.
Have a good weekend.
See you Monday.
Okay, thank you.
Bye-bye.
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 Ooh,